morning, all. See, the whole idea of why this number is required, I think the one of the reason where we looked at why it become critical as the way the cost of living has increased significantly. So many of us we think that okay, it may be just a dream, or is it a realistic goal? Can we achieve this? So I think that the whole idea is that to show that it is not just a number. If we really work towards, it's achievable, and we have seen for so many of our clients, we have seen that they have achieved this number or where they are able to achieve in next 5 to 10 years. So I think the whole thing what is required is that the consistent effort, and we should know the goalpost because that become very critical so that we can continue to hold. So I think the power of compounding, the time and the financial discipline is something which will create, because we really have seen the growth as the way Indian markets are doing and what we are expecting in future also. So if you look at last 15 to 20 years, markets are able to deliver returns, even if we not get same returns also, even if we get lower than that, but still it will do phenomenal growth over a period of a time. So the question comes, why 10 crore corpus required? So we have done one study in terms of to understanding that based on the monthly expense, what is the corpus somebody required if they retired. So the 10 crore of corpus is not just for retirement. So what we are showing it here is one thing is on the retirement expense perspective. Second thing will come your other need, which includes healthcare need. You will have emergency fund requirement, kids education. So idea is that if somebody have a 10 crore of a portfolio, all his needs are taken care. So we have done the analysis that, for example, somebody is at 50 and need to build corpus for next 5 year, next 40-year perspective. If we have 2 lakh of a monthly expense, then he needs 6.3 crore for retirement perspective. Same way, if somebody have a 3 lakh of monthly expense, in that case he need 9.5. So if you look at the idea of the 10 crore number is that to make sure that we don't need to worry about any sort of a long term challenges or any sort of other goals. And second thing, we have to consider that we are keeping into the mind the 8% type of a return. The reason why we are looking at 8% type of a return, because it's a post-tax return. And secondly, as time goes, the overall returns are going to come down over a period of a time. So our thing is, from a planning perspective, when we are doing a planning, we have to look at the conservative number, not we should go aggressive on overall perspective. Second scenario, we kept it the moderate post-tax return, where we keep it like a 7% inflation and 10% return. So there, if somebody have monthly 2 lakh of expense, then 5.4 crore, if 3 lakh 8 crore of a corpus, and considering there will be other funds which will require for kids education and other thing, keeping that into the mind, we have come up. This is what we'll be requiring. Third, which is a most of the people will be in that scenario, which is the low post-tax return, because many of investors who are keeping money in FD, they are keeping money into real estates. They will have the actual lower yield post-tax 6% type of a thing. So in that case, if you look at even just for retirement itself, you need very high corpus. So typically, if you look at it, will increase almost like a 9 crore if somebody have a 2 lakh of a monthly expense. That's the most important thing which we want everybody should have. That's called financial freedom corpus requirement. So somebody who think that okay, any point of a time I want to retire, and who are at their 35 to 40 year of a age and they wants to retire, what should be the corpus they should have where they can think. So this is the 50 year of a corpus requirement which we are looked at, keeping into the mind the different written scenario that if 10% is the return, and if you have a monthly 2 lakh of a expense, in that case, what would be the corpus? If you have, you will be able to achieve. So you can see, if somebody have built 6 to 7 crore of a corpus, then he will be able to take care of next 50 year of life to have their expense. So this is we call financial freedom corpus, because that will help someone to understand that what should be corpus that I should have when I take a call and take a break from my day-to-day thing and able to work around. The most important part is, if we are not able to manage our investment well, then how the fund requirement increase. So you can see from this itself, if somebody is getting 6% type of a return, then in that case the corpus requirement goes beyond 10 crore. It will he need 11.3 crore. So that's a big difference, where instead of somebody is getting 10% return, where he needs 6 crore of a corpus. So I think that's the most important part, that the overall ROI should be on higher than the inflation, to see that our money can continue to grow. Why we need so high purpose? I think the longevity, because as time goes, because of the improvement on the medical side and the other thing, the average life expectancy has increased significantly. Secondly, as we want to keep some part of the money to our family, as everybody will have an individual family, that also is making a challenge, where they don't have a supportive system which can help them in case of any sort of a crisis. Third thing, most of us don't have a pension income, so we have to build our own corpus to take care of or need and or requirements. Fourth is, I think, the AI or technology part, the way things are changing, jobs are not certain, where things are changing very dynamically. So it become very critical that if we have a good corpus, then at least we can plan well, we can do something different, and we will have things where family not get impacted. So technology is playing very large role of the changing of the need, because you can't think of that you will have a 60 year of till 60 year will be continue to work, we will have a stable jobs, because things are changing. I think the next part, what we have seen with many of our clients, global family concept, where kids are studying abroad, they have moved there. To post retirement, even parents want to stay there. So many times when we do a planning, we look at expense from an India perspective. But if you look at from a global perspective, then your expense will almost get doubled. So that's the one thing which we have to keep it in mind, that as scenarios are getting changed, we have the fund requirements going to increase significantly over a period of a time. Then next part is, I think, many times people do a mistakes in terms of doing a wrong products investment and other thing at an initial stage. Then at least they can understand the value of money, and then they can build up and do it higher at a next level. The first step, I think, is to start early, because that is something which is the most important part, more than anything else. So what most of us think that, okay, when I have a good amount of money, then only I'll start. But actually, more than money, the time is very critical, and that we can see with this example itself. If somebody is starting the SIP at the age of 25, the monthly requirement of only is 15,000. But instead of that, if we start at the age of 30, it will become 28. But if it start at the age of 40, so instead of same 15,000, he need 1 lakh of a month. So you can just look at that, how things different. So it is the most important part. Start early, and you can see that how much corpus that we need somebody to reach 10 crore at a different stage of a life. So I think the most important part, if somebody wants to achieve 10 crore at age of 60, and based on where he is. So somebody who is at 40, he needs to do at a 1 lakh of a SIP, somebody at a 50, then it become 4 lakh 30, which is become next to impossible to achieve. So people who are at an early stage of a life, they can able to build the real wealth, because post inflation even 10 crore also is not a big number if we look at when somebody at the age of 60. The whole idea of starting this webinar started when I was going through this one of the analysis, which make me to think that how it become very critical somebody to understand that how wealth creation happen. So I think once we understand the process, then we will be able to achieve. So if you look at to reach 2 crore, it need lot of time, pain, and other thing. But after that, if you look at, even if somebody is not doing any additional allocation, still at every 2 to 3 years, on an average, if you look at, he is able to build additional 1 crore of a corpus. So indirectly, the most important role as an investor is to make sure that how quickly he can reach to 2 crore of a corpus. So I think once he is able to reach a 2 crore of a corpus, then I think the real power of compounding start, where your money start growing on a quicker way. So we should understand what is our goalpost. So our goalpost as an investor should be as much as possible to reach quickly, because here your investment allocation require more, up to 2 crore of investment. After 2 crore, your patience require more, because even if you're not doing very high allocation post this corpus building, if you continue to hold investments, that itself can give you a very good growth. The growth which will be higher than in what you have done the investment. So you can start seeing that you end up building a bigger base over a period of a time. I think that's the most important part which make me to do this webinar, because many times we are not able to realize, or we are not able to forecast the type of growth which is possible. So at a one stage we have to work, after a stage our power of compounding will work, and that's something which we are doing, looking at 12% type of a return. So when we are doing a planning, that is what we should look at as a whole. We have done the multiple scenario thing, that okay, somebody is starting at a 1 crore, at a 2 crore, how he can able to reach quickly. So one is, okay, if I don't do any further allocation, once I have 1 crore of my current corpus, or 2 crore, if somebody think, okay, I want to achieve this quickly, how I can do. So the easiest way is, somebody is doing a monthly SIP. If he is doing a 2 lakh of a monthly SIP, in next 10 years, he'll be able to reach 2 crore of a corpus. In case of 2 lakh of a SIP, if you have a 2 crore of a corpus, 12.2 years, if he is having 1 crore of a corpus. So if you look at how add-on SIP will help you to reduce. But the most important part is, if we look at once we are able to reach the 2 crore of a corpus, then growth will become automatically on the higher side. So what is the step one? I think invest consistently every month, increase amount annually. So I think we always suggest that at least try the 10% incremental increase in the SIP, what we do as a whole. Because even if somebody is doing 1 lakh of a month SIP with 12% return, in 20 years, he can achieve 10 crore. But most of the people do a mistake, that they take out money in between, they stop the power of compounding. I think that is the most important thing which somebody needs to look at. Then next part, portfolio diversification, where equity is always be on a higher side, because it helps to create a wealth, but debt will help to provide the stability, and the alternatives like gold, REITs, and other, which able to do well when there is a lot of uncertainty. So fair mix of allocation help, and we will discuss later how we able to build that type of a portfolio. Third thing, whenever you have any sort of a lump sum money, start doing investment, and you don't need to do as a one time investment. When markets are high, we can use STP, that's called systematic transfer plan, where we keep it money on a debt side, and from there money get invested on the equity over a period of a time, so that you don't lose on the short term fluctuation. So always keep realistic return expectation. That's the one thing which we see in that people think that we will always earn 15-20% type of return. They end up doing investments which will make them to lose the capital itself. So our thing is that focus on a things which is right, not try to achieve something on just looking at the past data, because past is not going to be the future. In past, if mid and small cap have delivered 20-25% return, but same way will it be able to continue in a short period? There is no guarantee, because there is a lot of volatility is there. So when we are doing a planning, always keep it the moderate return. Don't expect more than 12% return. And post retirements, the expectation become should become much lower, because as time goes, the debt returns also going come down significantly. In equity also, if you look at if the earning growth, if it's come down, then there also impact is going to come. The next step is financial discipline. I think stick to the plan, review it annually, and scale investments as income grows. I think these are the base fundamental which somebody needs to look at, and always review it annually. Don't try to do that every quarter, every month you review your portfolio and do the changes, because that is not going to help you. Actually, it will harm more to your portfolio, because every fund go through a cycle. There is nothing called a best fund on the overall investment side. You have to give the time for the investments, and that is something which will help you. Otherwise, what will happen that you end up buying a fund which is doing today well at a peak of the cycle, and you exit a fund which is at their lowest end of the cycle. And that is what most of the time investors do a mistake, that they just look at the performance and try to take a call instead of understanding the market cycle, because that become very critical. So we always say that 5 years is the right time where you will able to see the real growth of a fund. The next part which comes that okay, how we can able to achieve. So if you look at in a simple level perspective, I think somebody who wants to achieve in 20 years 1 lakh of SIP can help. If 31 years 25,000 of SIP. So point is, it is not a big number to achieve as a whole. If we plan well, give the time and hold the investment, it can do very well. And that is what we have done with the multiple scenarios, that how much of a corpus, what it is required for someone to achieve on a overall perspective, in a different time frame perspective, with 10% annual increase. So till now we were talking about just doing a SIP as a normal. If we just do a 10% annual increase, so what it was required earlier, 25 years to reach 10 crore of a portfolio. If you look at in 25, if you look at in the earlier slide where we talk about 20 years to do 1 lakh, if you look at it has become 15 years. If you just do 1 lakh of additional additional on the SIP side. So that's a big difference when you are able to do with some sort of a discipline approach and do a regular increase. It will help you to achieve on a much faster way as a base, and you can achieve your first milestone in 5 years itself. So if you look at the building a 1 crore of a corpus will be can be done in the 5 year itself. If somebody is starting with a 1 lakh of SIP with doing increase. But one thing which you will see the difference, 5 year you are reaching 1 crore, and 15 years you are reaching 10 crore. So which means in 10 years you are creating a 10 times portfolio. So that's a one big thing which somebody needs to understand, that how big numbers can be achieved in a short period itself once the base has become bigger. So 1 to 10 technically, if you look at just in 10 years, if you do 1 lakh of SIP with 10% increment. So I think the asset allocation become very critical. So it should have a good fair mix of equity, debt, gold, real estate, and that provide growth with the stability. So typically we suggest 60 to 70% of the portfolio allocation towards equity, 20 to 30% debt, 5 to 10% on the gold, and real estate. It could be based on how the overall portfolio allocation it can be decided, because I think that's the most important part which somebody needs to look at. Because if we are not done the proper asset allocation, we're not able to build a real wealth. So we have done the scenarios that in different scenarios how portfolio is able to deliver, and you will be surprised to see that if you look at, even somebody have a good mix of a debt and gold, even in that case also, if you look at, equity is able to deliver same the balanced portfolio is able to deliver same return what pure equity has given. So sometime what we think that okay, taking high risk will get higher return may not be necessary in a longer term, because if you do a proper asset allocation it can do very well. And another thing, it will reduce the drawdown. So where the chances is that, for example, in equity maximum drawdown can go 59, here it will come down to 40, and here 27%. So somebody who really want to make sure that okay, I don't want higher volatility, but with the good return, then doing a combination approach also make a lot of difference. And we have looked at the live example also to show that how the really the wealth creation has happened over a period of a time. So one of the fund which have a very long history, SDFC Balance Advantage Fund. So if you look at from the starting of the fund, if somebody's plan and look at the regular SWP also, even if it's taking out regular money on the investment, but still if you look at the portfolio can grow significantly, almost 8.57, and that we can see the since inception return. So fund has delivered almost 18% return, even having 30% allocation on a debt side. So it is not a pure equity fund. So the point what I am trying to convey is that sometimes you don't need to take high risk to get the better return. And this is something which is asset allocation will help, and you have to give the time. So these are very critical things, and these funds have done better than even equity pure equity fund in a longer period of a time. The second type of a fund which we look at is the dynamic asset allocation fund, because our view is that that's another way where, as a fund level, do the changes in the debt to equity allocation, and that helps to deliver a good yield. So you can see that, for example, we have taken a see, all these are the examples. So these are not recommendation to invest the fund. So that is something based on the risk profile somebody can look at. We are trying to convey that funds which are there in the long term in the investment side, how they have helped many investors, because many of us we don't know how it can do a wonder. So you look at how effectively as a fund level is able to manage the debt to equity allocation, and even with the lower equity allocation, if you look at the return. So if you look at, this fund has able to deliver last 15 years same return what equity has delivered. So if you look at Nifty Kaggle has delivered 12% return. If you look at last 15 years, this has delivered 12% return, higher than Nifty, even having only 50% equity allocation. If you look at net equity allocation on a overall perspective, it's hardly 15%. And second thing, it protect the downside risk. So for example, when markets were down, so like for example, 19 to 20 markets were 20.5% down, this fund was down 13. When markets were flat down, it has given a flat. So when markets were flat, it has given a positive return. So that is the power of these type of a fund which can help you to deliver better than what your debt can do, what your pure equity can do, or what your FD can do, which protect the downside plus create the wealth. Because I think that's the most important part, and at a later part we can look at to do SWP also doing this. So if you look at how many times the fund has delivered, so if you look at 76% of the time, if you look at fund has been on 10 to 15% return as a whole. So that is something what we look at. to build in a longer term, which is equal to what Nifty has delivered. So the point is, many times we don't need to take a high risk for a high return. If we plan smartly, we can do better than what market has done using asset allocation. The next part is the SWP. Many times, what we have seen, people keep money into FD and all other instrument, thinking it will give a regular instant interest income. But if you look at STP, SWP is a more tax efficient way because here you are not paying the tax on the whole gain. Because if you look at on SWP, predominantly it will have a mix of the principal plus capital gain during the payout. So that helps to make sure that your tax liabilities come down significantly. So this is the one example of 1 crore of an investment somebody has done in 2010. How fund has delivered and what is the overall yield. So you can look at fund is able to give 12% type of a return plus able to give 75,000 of a monthly SWP and with very low tax impact. So you can look at the tax impact is hardly 1%. And we can reduce it further because normally we suggest that in the first year you should not take out. First year let money to grow, and after 1 year you start taking out from a regular income perspective. So that is what we are trying to convey, that the most important part is that how well you plan and how we are able to give the time. Don't look at just 1 year of a return, think that things are not working. The third fund approach, what we suggest is the multi-asset approach, wherein you have a fair mix of equity, debt, gold, REITs, preferential shares, plus commodities, and within equity, large, mid, and small cap. And they do a covered call option to increase the return on a portfolio level. So that is something which, if you look at, has able to deliver phenomenal returns. So if you look at on a 5 year CAGR, it is able to do almost 18% type of a return. So the next is how the portfolio mix make a difference. So if we do a, if we go through today where we have seen large, mid and small cap are doing good, but if you look at over a period of a time, they go through a cycle. So I think that's what we have to understand, that we should invest when they are going through a down cycle, when not they are through up cycle, and that's where the real growth come. And mid and small cap always delivered very good return in a long term, but the downside is always on the higher when you are going at the end of the upcycle. So some of the options what we looked at, that on the equity side, equity mutual funds and PMS, or multi-cap, some of the good funds which can be looked at. Again, it's not advice. We are just suggested that some of the funds which can do. So we can have a fairly good mix of mutual fund, PMS, index fund, direct equity. Direct equity normally we don't suggest. If somebody is experienced, then only we should do. Otherwise, I think mutual funds and PMS is a ideal way from a location perspective. The next thing which always people think that okay, gold has done phenomenally well. That's something which can do better than equity all period of a time. But if you look at gold, also has gone through a lot of consolidation. So if you look at 2012 to 19, gold has given zero return. So after that, it had a good phenomenal run. So idea is that every asset class go through a cycle. The point is somebody needs to have fair mix and give a time. So in our view, I think gold continue to do well, but it cannot give you equity type of a return in the long run, because as things will get stable, you will see things will have a thing. So it is a good for a mix, but not as a core holding perspective. And these are the funds which we are showing that how different fund has delivered, which have a 20 year of a record and that deliver 15% plus type of a return. So point is, yes, markets have created a wealth, but the point is how we are able to take an advantage, because the real differences come. So if somebody wants to really want to create the real wealth, he needs to be there for a 20 year with the investment, because you can see the difference here. In 15 years, it has created a 5x wealth. But if you look at 20 years, it is 16x. So that's the difference what comes. So somebody who's invested 1 lakh, it becoming 16 lakh 50,000 in 20 years. So you can look at all these funds, how they have created a wealth. But the most important part, look at the time difference. So we say that if you want real wealth, give a 20 year of a time to investment, and we give the same time to other investments also. So we hold real estate generation to generation. We hold gold from one family level to other. We the way we treat the other investment, we have to start treating equity also in the same way. It can do phenomenal. But I think the most important part is the time factor, and that we can see with the number itself how really different funds are able to create a wealth. And the next is, I think that as I was discussing, the more than timing, the time factor, because even if somebody enter at a wrong time, still if he has given a time, he will be able to create a wealth. So even somebody has done it during COVID crash, even about before that, still is able to create 15% type of a wealth. So it is not that if you did something wrong, you will lose the money. You just have to give the time. And that we can see with the another thing, that how the fall to recovery. So whenever fall comes, falls are smaller and for a very short period of a time. So you can see with this chart, like last 20 years, if you look at the falls, the time period is very lower. So if you look at after 2010, if you look at most of the falls are for 2 months to 1 year, and after that the recovery is very strong. So we should not get carried away, but just looking at the market fall, we should look at that as a opportunity. So if you look at 2008 to 10, how markets have given 157% return, where 1 year markets have gone down by 61%, 1 year, 2 months. Then here in 2010 to 15 cycle, markets have down by 28% in 1 year, 2 months, and then it has moved by 96%. Same in 2015. So we will see it every 5 year, one downfall, which will be 20 to 30% type of a thing. But after that, the growth really will be on the higher side. And that is something which we have seen today also, that how last 5 years markets have moved almost 200%. Second thing, people always think that okay, markets are at a whole all-time high. Should we do allocation? And if you look at post all-time highs, also if you look at the market returns, always be on a higher side, because the most important part is the earnings. We just look at the one part is the index level, but we don't look at the earnings. So as even markets are going high, if earnings are moving up, then market continue to do well. So even at a post all-time high, also market has delivered phenomenal good return, especially on the large cap side, what we can expect today. The next thing, people always think that okay, I should do a regular profit booking and then I'll create a wealth. But if you look at historically, buy and hold is something which have created a big wealth than doing regular portfolio level changes, profit booking and thing. Because if you look at, because if you miss one part of the overall thing, I think you lose out the whole thing. And that is something which we can look at with the real data, how wealth creation has happened over a period of a time, compared to somebody is going that with thinking that okay, at every 20% of the profit or 30% or 50% I'll exit. So how we can do a tax optimization? I think hybrid funds are more tax efficient with equity type of a yield. SWP is a better way than doing FD or any other instrument on the investment perspective, on a long term perspective. Then, from a short term perspective, income arbitrage funds are better to get post tax almost 6 to 7% type of a yield without taking any sort of a market risk. So, these are some of the important things. Most important thing, I think, if you look at, I think annual rebalancing, maintaining the asset allocation, track the performance, increase the SIP, and I think consistency and the discipline are the main key. If you look at from the compounding perspective, what's my final thoughts? I think start early, stay invested, choose tax efficient investment option, review and adjust on a yearly basis. And I think wealth is all about time, discipline, and the strategy. I think that's a more important thing, because today most of us, we don't know where we want to reach. If we know where we want to reach and we have seen how it has worked well and we are able to do, then I think there is no goal which is not achievable. I think that's all from my side.